Uh, thanks everyone. Thanks Nari for the opportunity to talk about this. Happy New Year, everyone. 2022, about a year ago, we talked about the um, other strategy, the 85-35 strategy. Today, let's talk about a strategy that I came across, Zebra. This is a strategy. It's been kind of in vogue for probably some time now, and it is something that people are using instead of buying stock. So it is sort of a stock replacement strategy. By stock replacement, what I mean is instead of buying a stock for say $3,000 of Amazon, you can buy the same effect for about 15% of it. Say instead of $3,000, you could spend only like $400. And then if the stock goes up by $200, your position will go up by about 50%. And that's the whole idea of the zebra option. So we will go through some examples of what it is and how it works. And it is just a mathematical strategy. So I'll keep it very simple with the strategy, and then I will host any questions that you may have. Um, okay. You can stop me if you think you need to. Is this okay? The bottom.
Yeah, we are seeing the extrinsic value slide.
Okay, you are able to see the extrinsic value side. Okay.
Yeah.
I'm just giving you, I'm assuming that you all know what options are. You have gone through Nari's course on options, the basics and everything. I'm just giving you a brush up on the extrinsic value because this strategy focuses on extrinsic value. So the idea is to pay minimum near zero extrinsic value when you get into a position. That's what this strategy is all about. So extrinsic value itself, what it means is it's a value that's over on top of the intrinsic value that you pay, because every option has a premium. The options premium includes intrinsic value plus an extrinsic value that gives you the total value of the options premium. So for example, if you're going to buy a stock for a strike at $100 stock at $100 strike, you have to pay a premium of $5 or so to get that option to buy at $100, say by next month or whatever. So that $5 becomes extrinsic value. That is value on top of the stock price that you are paying. So the stock has to move at least $5 for you to make any money. If it moves less than that, you will be in the losing position. So intrinsic value is obviously the other side of it. Together it forms the premium. The Thinkorswim platform and most other platforms gives you the extrinsic value for every option position right on the screen. So for establishing a zebra transaction, we will be doing that. We will be using that. Okay. Let me just touch upon delta again. And this strategy uses delta. Delta is just a refresher for some of you who may not understand, who may already know delta, but I'm just a refresher. Delta represents a rate of change of option price with a dollar move of the underlying asset price. So if the stock moves up by $1, how much your position is going to move up by? So normally when you buy say at the money call, your delta will be close to 50%, 0.5. So if the stock moves up by $1, your option position will only move up by 50 cents. And in the case of Zebra, the expectation is when it moves up by $1, your position will move up by $1 all because your net delta is full one. So you are paying you are paying a fraction of the price of the stock, but you are getting a full delta. So that when the stock goes up by $1, your position is going to go up by $1. On the corollary, if it goes down by $1, you're going to lose $1. Okay. So that is the idea of delta and extrinsic value. Those are the two things that are critically used in establishing a position for zebra. Let us now jump right back into zebra. What is zebra? Zebra stands for zero extrinsic back ratio spread. There are many strategies in options, as you all know. You can buy a call, you can buy a put, you can sell a call, sell a put, you can buy a spread, a bull spread, you can buy a bear spread, you can buy a condor, you can buy butterfly, you can buy a strangle, straddle, iron condor. There are so many different strategies out there that you can do. Back ratio is one of those strategies. Back ratio strategy is a very interesting strategy. It's a little bit complex in the sense that you buy two and sell one, and sometimes you sell two and buy one. So the back ratio is balanced, is out of balance transaction. So that's what we'll be using here. Zero extrinsic value, net zero extrinsic value. So we'll be selling one position and buying two positions. Net of all of that, extrinsic value will be zero or near zero. That will give you a total net delta of 1, which is 100, which means that position goes up or down by that. This can be done on the put side or on the call side. If you are bearish on the stock, you will do it on the put side, and if you are bullish on the stock, you will do it on the call side. And they are saying ideally the implied volatility, if you go back here, the implied volatility is part of the value proposition for extrinsic value. So what they are saying is the ideal position is the implied volatility is low, but it's the mathematically this strategy works either way. And if you look at the chart, the profit loss chart at the bottom here, what you see here, I don't know whether you can see this bottom picture.
No, we cannot see the chart.
Oh, you cannot see the
We are,
chart?
we are still seeing the PowerPoint.
No, no, there's a chart in the PowerPoint. You are able to see
Oh,
my
yeah,
mouse?
yeah, yeah. Okay, okay. Yeah.
I'm calling it a chart. It is just a
Okay, okay. Right. I thought it was a design. Okay.
no, no, it's not a design. So you get into a call. In the call, you get into a call here. When the stock moves up by X dollars, this goes keep on. The position keeps on increasing in value, and the position has no upper limit in the sense that um, it is like you have own a stock. And at the lower end, your losses are limited by the entry point you have made, which is about 15% of the stock value. So that is your max loss. So the max loss is minimized just like in any option, call option, but the max profit is not limited because you are buying two calls and selling only one. And that's the back ratio that gives you that. In the put side, when the price goes down, the profit is again unlimited. We're expecting the price to go down as you see here. Okay? That is the basic definition of the position that you take. How do you set it up? You set it up, you buy two in the money puts in the case of put zebra and sell one at the money put so that the net extrinsic value is going to be zero. I'll show you in the example on the Thinkorswim platform. Say, for example, here I am on Google, and normally these zebra positions are taken from 30 to 60 days out. That's when it is most, even though technically you can do it on a leap as well, you can do 1 year ahead, you can do 3 months ahead. Most ideal, I would say, will be 30 to 60 days. I will tell you why by going through the charts. Here, if you are going to set up a, a put in this case, let's say you think Google is now 2771, you think it's going to go down to say 2600, which means it's going to lose $171 of value. Then you will put it on the put side here. You will say buy back ratio and you are paying a premium of you are getting a premium of 104 and you have to go down to say 52, say 2890. So you are going to buy 2890. So for $235, you are taking a position per share, and if the price of the stock goes down by 200, or 170, your position will be 170 plus 235, $400. You will make $170 profit on this position, even though you invested only 235. If you were to sell Google at this time, you will be minus 2771. So similarly on the call side, you will do just the flip side of it. So for example, here you will buy back ratio and is 180.
Bala, one question on the put side.
Yes.
So for example, in this case, now if the stock goes north, now
I mean,
then you
will lose that much.
Lose money.
yeah. So if the stock goes north, no, we don't lose money. No, we don't make any money in the put.
No. You will lose the 238 up to $238. You will lose.
Yeah, no, but it's net zero, no. So because no, with the premium what you collected, you are distributing back into buying two puts. Basically,
No, you are still paying a premium of 238 net premium.
See, you are paying the your intrinsic value, right? So basically, extrinsic value is 0, but you are paying the intrinsic value.
Yes.
true. Now what I'm saying is like no, the money that you got by selling a put, you are distributing that into buying two puts. No, at a which lower level?
No, I'm not.
It's
Only
not
getting the extrinsic value,
correct.
not the actual.
So yeah, I think Bala, why don't you start from the beginning and go a bit slow and explain the put again, so that way people will understand.
Yeah. Can we just look at that? Can we look at just the sell put and the buy put alone, that transaction? Yeah, sorry.
Here, I'm telling you, when you set up, if you are bearish on Google, as an example, okay?
Yeah.
If you're bullish, you will do something else. If you're bearish on Google, you will buy two in the money puts and sell one at the money put. And at the money put will give you, say, $108 in this case. And the extrinsic value of two in the money puts will be $54.
Yeah,
Okay.
at that point, it's net zero. Right? So the
No.
premium you
Only
collected.
the extrinsic value is net zero. Your premium, the total premium. Remember, the premium is intrinsic value plus extrinsic value. The intrinsic value you still have to pay.
Correct.
Okay, I got it. Okay.
So you are not distributing the premium. You are only distributing the extrinsic value so that it becomes 0. And so
Yes.
when you said 2 ITM puts, do you mean 2 contracts?
Two
But
contracts or 20 contracts or two times the number of
yeah.
contracts you sell.
So looks like you're not changing the default. So it's defaulting to 10 contracts, I think here.
Yeah, that's the default I use. Yeah.
Unless maybe you're a big whale.
No. I am no big whale. But the point here is I'm only going to go by this, right? On the put side,
So you said at the money call, you said delta will be 50, right?
Around 50, yes.
Yeah, but what delta do you choose for in the money calls?
Okay, let us go to the call side.
Yeah,
Okay.
sorry, no. Put. I'm saying put. Let
Yeah,
us take
before, yeah.
put
In the
and
put
understand
side
first.
here, I chosen, I don't go by the delta, I go by the extrinsic value.
Ah, okay. You just okay.
I
You
got extrinsic value of
so
104.80
you divide it by 2 and then
divided by 2, that is $52.
okay.
I just bought this particular one, which happens to be 0.67 delta. So
Okay.
Yes.
0.67
So
delta,
Bala, at this point, basically it's a net down of $220. Is it right? With respect to
net
this
down
market.
of $20. Yeah. So the position is 0.67 times 2, that is 1 point, let us say 1.35 minus 48. So you got about 90 delta. 90 delta. So you are not getting a full 100 delta on the put side, but you are only paying 221, which is less than 10%. So that's the way it's working out. Maybe the
No,
price.
but you said whatever premium you are paying is almost equal to the intrinsic value, right?
Yeah.
So how do you how do you work out? I mean, just for cross checking, I mean, how do you
So
see
there
that
is no intrinsic
intrinsic?
value for the 2770 put. It's all
Okay.
extrinsic. It's all extrinsic. So the 221 you are paying is $110 for the 2880 put. And the 2880 minus 2770 is 110. So you are paying basically 110 times 2, and that is 220. So that means that is the intrinsic value that you are paying for. Do you follow?
Okay.
Let me repeat that.
So because you are buying two contract, 20 contracts here,
Yeah, I'm buying
that
two.
is why you are dividing 221 by 2, and
Yes.
that is the difference between the two strike prices.
Yeah, that is the difference between 2880 and 2771 or
Correct.
2770. Yes.
Yeah. So the difference between the two strike price is the intrinsic value,
Intrinsic
and because
values.
you have two contracts, it is double.
Yes. So the beauty
Bala,
is, yes.
yeah, just a question. Now, like when you buy the puts or the sell, or sell the puts, like, I mean, don't you need to have adequate equity to cover?
No, because you are buying two puts for every one put that you are selling.
Mm-hmm.
So you are net positive put here. So you don't have to have any cash balance other than this $221 times 100 for one contract. That is 1 to 2. You will spend only $22,000 to buy that put, and that's all the money you need. You don't need any more money.
Okay.
So, Bala, can you go over the delta calculation for this?
What is that?
No, sorry, can you go over the delta calculation? How is the net delta one? Can you just go over that?
Okay, all right. The delta calculation, I'll go over it one more time. But by the way, to set up the position, you are not using delta. To set up the position, you use extrinsic value. Zero extrinsic back ratio. That is zebra. So your extrinsic value here is 104, and extrinsic value for the 2880 is 55. Okay, so I should probably do 2890. Okay, maybe that's what. If I do 2890, it'll go to 238. So the 2890, now let us go and calculate the delta. The delta for 2890 is 67, minus 67. On the put side, it's negative, that's all. So you are getting minus 67 and you are buying two contracts. So that is 2 times minus 67 is minus 134. And then you are going to sell 48. So you have to add 0.48 to 134. So you are getting a net delta of about 86. So in this particular case, it so works out for the zero extrinsic value back ratio on the put side, you're only getting 86 delta. Normally you will get 90 to 100 delta. Here, I don't know whether the pricing here is accurate. The pricing may not be accurate. The pricing may reflect
Yeah, the after hours, right?
after hours, maybe.
So what is important? Getting the delta to 100 is important, or just squaring off the extrinsic value?
Squaring of the extrinsic value is the most important thing. In the zebra
Okay.
strategy, it's all about extrinsic value. In this strategy, you square off the extrinsic value to net zero. Once you do that, delta will be around 100. And that's why it moves, the position moves by that much every time the dollar moves up or down. Let's look at the, if you don't mind, can we look at the call
Sorry,
side?
can you please start this transaction again? I wanted to see how you initiated this transaction.
Okay, on the call side, shall I do it?
No, do it in put first. I want to see the put.
Okay. So
So
I just go here, I just right click on the put.
you want to cancel this order entry and start from beginning?
Yeah. Okay. I go here, I put a right click on it
Okay.
and I just buy. I click the buy because I'm going to buy, because buy basically there is no real
Yeah,
difference between buy and sell. Buy means you are going to pay a debit. That's
correct,
all.
correct.
Buy and then you go to back ratio.
Oh, back ratio. That's what I missed. Okay. I was letting people in, so I missed that.
Okay. So you buy back ratio. When you click back ratio, it will come up with some back ratio position.
Ah.
You don't worry about what it comes up with. You only know that this is 104 that you have picked at 2770, where you're going to sell. The sell put is going to be at 2770. At the money you are selling. Remember. So at the money you are selling. This is number 2.
Yeah. No, this I understood. I missed the back ratio. That's all.
Okay, and the back ratio, and then you come here.
Yeah, then you can adjust.
Then you adjust it. So 2890. So you pick 2890. Now you pay 235 per share. That is your price. 235.70 is your price, and then you are in the position.
Bala, can you go back to the slide, please, just for a quick second?
Yes.
So this is actually, we are anticipating the stock is going down. It's in a bearish market, right?
Yes.
Right. So we are basically limiting our loss and betting on this will go down, right? So
Yes.
if it goes up in the reverse way, Zebra is going to be saved a little bit, right? Because we already sold one put and buy two put. So basically we are in the negative territory right now, and stock going up, then you definitely lose the whole value of those two put you bought it already, right?
Yes.
Only thing is the money is collected.
You will lose up to 235. You will lose if it goes up to a point. If it goes down up to a point, you will lose up to 235.
So it's
Basically, if you understand, Bala, if it goes north, you lose the premium, the 200 plus odd dollars.
right.
And then if it goes negative, and as long as it's between the sell and the buy, then that is a loss, that is a constant maximum you lose. But if it goes below the buy, then you sell one of the put to offset it and then make money on the other put. Is that in a nutshell?
Yes.
Got
So
it. Okay.
I mean, you will limit your exposure. If in a bearish market you are going to do this one, you are literally limiting the exposure and the risk we are going to take it.
Yeah,
Right?
that's true. But I want to make a statement here, which is important for people to understand, is that when you buy a put, you are limiting the exposure by the action of buying a put. So when you buy a put, you limit your losses. When you buy a call, you limit your losses.
Correct.
That is what is coming into play here. Except that since you have sold a put and bought two puts, the two of them will negate each other up to $110, and then the other one you lose maximum of $110. That's all. So you
So,
to
Bala, like, isn't the net effect, I mean, if you're buying two and selling one, that the net effect would be like you're buying one call, one put.
yes, yes.
But they are at
However,
different strike price, right? So they don't match exactly, right? So
see, the zebra strategy is mainly to give you the opportunity to get out within a day or two. For example, if the Google goes down $10 tomorrow,
Mm-hmm.
you will get a profit of $10 in the position. And then if you think it's going to go back up, you can just get out right away and make the $10. See, unlike if you just buy a put, and if it goes down $10, the put may have a delta of 50. Then if it goes down $10, you will only get $5 profit because it moves only half of the delta value. Here, since the delta value is pretty close to 1, in this particular case, it's not working out like that. But typically, it will work. This strategy will give you close to 100 delta when you get into a position.
Mm-hmm.
And as soon as the market moves, even 2 or 3 days, if the market moves sufficiently for you, 10%, 20% in the direction where you are aiming, you can get out of the position and you can make the money. You cannot do that when you buy a vertical spread or when you buy just a put or when you buy just a call, because it moves only by the delta value. Here, the delta value is full and you are only paying a fraction of the stock price. You are not paying the full stock price to get 100 delta. That is the whole concept here.
It's
Okay.
really good. It's really good for a bearish earning play.
No, it's good for bullish also. I will show you.
that is
Let's
call.
go to,
Oh, that's
Let's
a
go.
call. I was talking
Yeah.
about this one, the specific
Bala,
one.
is it possible to do the analyzed trade like you can do for anything for
yes,
this? Okay.
So, Bala, I have a question. So
yes,
you said that it is close to 100 delta, give
yes.
or take 5 plus minus 5, that's fine. But let's say if we pick up something which is like a 2 months from now, right, the strike, then theoretically, even after 1 month, assuming stock keeps going in the favorite direction, do you think delta will still remain 100 after a month or so, or the delta will change drastically?
Not drastically, but the delta will change. The delta has the skew effect because what will happen is if the delta of the long put keeps increasing and delta of the short put also will keep increasing. So depending on how much the long put is increasing, if the long put goes from 67 to 70, so you're going to pick up 2 times that 3 delta, 3 plus 3, 6 delta. And if the short goes up by 10, your delta will go down a little bit. Or if the short, it all depends upon how the delta moves. And as I told you earlier, this is important. Going back, let me go to this slide. See, implied volatility. So today's volatility determines the extrinsic value and also the delta. Delta also is driven by implied volatility. So if today's volatility is say 30%. 1 week from now, the volatility is 20%. The premiums will shrink. the delta will shrink. So how the delta moves depends upon how much the dollar value has moved and how much the volatility has moved. So those two factors are affecting your delta and your extrinsic value. So you can only worry about when you get into the position. Once you are in the position, if it is going in your direction, if you are favorably moving along, just enjoy the ride. That's all. And after that, you cannot worry about delta. Whenever I would say have a threshold profit. If your threshold profit is say 50%, 40%, when you reach it, exit the position. That's it.
Hey, Bala, how is it different from vertical? This is called zebra. How is zebra different than a vertical basic spread?
Okay. The difference between vertical and
Contracts
zebra,
to one, right? Yeah.
the vertical is not giving you close to 100 delta. So what happens in a vertical is vertical will have a net delta. So for example, if you don't mind, let me go to a call side and then we will address the question about vertical versus zebra in that call side equation. Okay.
For the verticals, I think delta is very small. The fact that it's
Yes.
vertical.
So this whole zebra policy is not to keep the delta small. The net delta of the position is a full 100. Whereas a vertical will have for the same, say for example, if I take a, let me do a call delta for the same 43 days on Amazon, for example. So we will do a call delta, call zebra, which is at 51 delta here and $133 premium. And half of that is 66, let's say, and 66 is say 30 20. Okay, so we buy back ratio, and then we buy 30 20. So we are going to spend $400, $402.65 to buy this position. 2 we are going to buy at 30-20 call, and 1 we are going to sell at 32-30 call, which is the current price. So this net delta will be, if you calculate, 30-20 is 73 delta, is 73 times 2 is 146, and you multiply, subtract 51 from 146 is 95. So you're getting a net of 95 delta here. Now, if you do the same transaction on a vertical, okay, just to complete the zebra point here, you are getting nearly 95 delta for spending only $402 when the stock price is 32.24. So this means if the stock goes up by $200, this price of this position is going to go from $400 to $600, and you're going to make 50% profit. Whereas 200 over 3,200, if you had bought the stock, you are going to only get 6% profit or something like that. What is
Yeah, it is high leverage, right? So, but if it works out the other way, also you lose 50%.
You lose 50%. That's right.
Correct.
But the
So it is
idea
a
here
very
is
highly leveraged strategy.
a highly leveraged strategy, and this is the reason why I will go into the technicals right now and show you from the technical what is the appropriate time to get into either a bull strategy, bull zebra, or a bear zebra. Let me try to answer the question about the vertical. When you do a vertical, the same vertical, let us say for sake of argument, you do the same vertical. You sell at 32.30, buy at 30.20. So this is going to cost you, let me make it custom. If I go to 10, this is going to cost you $134. So instead of $402, you only spent $132. However, your profits are capped at $210. That's all the money you can make in this position. And if the stock price goes up by $200, your net delta here is going to be 51, and to be subtracted from 73, you are getting only 21 delta. That means your position is going to go up only 20% for every dollar move of the Amazon stock. If Amazon moves favorably by $200, you are only going to get maybe $40 or $50 of the move, and that is the only problem. So the idea here is vertical will also work, and a lot of people do verticals based on technicals, and Zebra is a more full strategy of getting all of the money and be able to get out within a few days. Here you have to get out at the proper time. So there's nothing wrong with the vertical strategy. The vertical strategy limits your profit. Zebra strategy does not limit your profit. If there's a big breakout and the stock really pumps, then you will get all the benefit in the Zebra strategy. Here you will be limited at 30 to 30, at $210. That's your limiting profit. And the second is when the dollar moves, you won't have the full movement. Those are the two deficiency of the verticals. However, you are only spending 134 versus 400. So you are spending less money on the vertical. So it's your choice. Vertical is always a strategy, but Zebra is a specific strategy to take advantage of trying to get close to 100 delta as possible.
So Bala, here options to start with itself is riskier, kind of like playing with the fire kind of a thing, right? So now we are trying to put more leverage that itself will make fire equal to like 4 times the fire if it goes in the negative side to against you, basically, right? That means that if it is not moving the direction that you thought, then it'll burn you 4 times the speed, right?
Yes, no doubt about it.
That is true. Whenever you are long options, right? So whenever you are buying option, that is exactly true, right? Because if the market
This is the
goes
reason
against you,
why
then
I have suggested a different strategy, which is you buy 85 delta leap and sell 35 delta in a near term. Then even if the stock price drops, you have nearly a year time to recover the price, and you can just stay quiet and you can recover out of the position. So there are other strategies to alleviate what you are talking about. This particular strategy is more of a technical strategy. When you know that the stock is going to move, you try to do this. So for example, let me go into the technicals. Yeah, go ahead. You had asked a question.
No, I think I got it. Basically, when you are 100% sure of the direction, you got the confidence, and it kind of like at the bottom or the top kind of a thing, then instead of taking the 20%, 30% to a dollar, take the dollar to dollar and ride take the big ride, basically. Okay.
Yes.
And Bala,
yeah,
I think
you
another
reduce your investment, but you have the full advantages of the stock going up.
Yes.
Right.
So that's
Bala, I
Bala, if
think
you can show
another
the risk
example.
profile for that for the Zebra option, that may compare and contrast with the vertical spread risk profile is clear, right? That max profit is what the difference between the sell and the buy kind of thing.
Yeah. See, yes, you are right. And the only thing about vertical spread versus this is if you do the analyze of the trade, you want to do that, I can do that. But let me just talk to you about the technicals. I'm just using Amazon as an example here. You could do this technical analysis on any of those things. See, if you look at Amazon, this is a 1-year chart of Amazon. See, look at it. It has gone up and then it has gone down, and it has gone up and then it has gone down. It has gone up all the way to 3700 and then came down all the way to 3100. From here it went up to 3500, came down to 3200. From here it came back up to nearly 36 something, and from there it has come down here. So this Amazon is going every 2-3 months. It's going like a yo-yo. So one could think that, hey, it's now due to go up again, because you see this V-shaped things going on, and maybe this W will continue again. And so if you believe, so from here for the next 30 days, Amazon will go from the current price of 32.24 to about say 3,500, then there's a $300 move possible in the next 40 days. That would be the logic to get into a zebra position on this.
Call
Instead
side.
of, huh?
On the call side, I say. Yeah.
On the call side.
Yeah.
Now, if you take another stock, I don't know, I looked at Caterpillar. Take a look at Caterpillar. Caterpillar also does the same thing. It goes up and then it has come down. And then it has kind of gone sideways. It has come down and gone up. Come down and it has gone up. Now it is sitting here. Now the price today is 227 and high over 1 year is 246. So maybe somebody will say this is where it is going to go in the next 30 days. I don't know. But if you believe that this is going to repeat, it will be a good idea to bet a little bit of money on a put zebra on Caterpillar and a call zebra on Amazon, if you believe in this technical analysis. And that is just a thought. And of course, you can do just buy a put, just buy a call, you can do a spread, you can do many other things. Zebra is one other strategy that you can employ.
Hey, Bala,
Yes.
this is Ajay. So question
Ajay.
for you. Basically, in this strategy, you always have one naked call or one naked put. Have you seen
No,
a
no, no, there is no
situation?
naked call here. There
I
is
mean,
no naked
basically, you
call.
have one uncovered, you're not selling against one position, right?
Yeah, I don't have a naked call. I have a positive long call.
I mean, long call or one put which is not covered, basically. Have
Yes.
you seen yourself chasing or converting back ratio into a vertical later on if you
Yeah,
don't
I
want
have
to
done
sell
that.
it?
I have done that. Actually, as a matter of fact, I did exactly that on Google, because my position, I took, I did that on Google. Where is Google? So I did that on Google and it went up. I bought a zebra here and it went up. I made some money and then I said, you know what? I have a plus call, long call on it. Now I will convert that into a vertical and I sold premium against it. And I now have a vertical sitting there.
Okay. So you don't have
You
to
can do
close it
that.
in 3 days. Yeah.
Adjustments to this zebra position is depends on what happens. If it goes in your favor and you want to make a couple of more extra dollars, you can certainly go and sell. But don't do that when you enter into the position. Once you enter into a clean zebra. Once the zebra moves in your favor, then either you can get out or you can just sell a call against your zebra and make the money. Yep, you can do that. I do that all
Okay.
the time.
So Bala, a couple of questions. One, you said on Amazon,
Mhm.
if you think it's going to go up, then it's a good way to bet. But you're betting significant money, right? I mean, it's still what 300 or whatever that number was times 100, so it's still a $30,000 position,
Yes.
correct? So it's still significant money to bet on a play like that.
Yeah,
Yeah.
but as
There are so
compared
many
to
other stocks with lower price, right? Yeah.
no, but you can do the same thing with lower price stocks also. But I'm telling you, in comparison, you are playing a 32 24 stock, a stock that is $3,200. You are entering in with only a $400 investment on a stock.
Right.
That is how you have to look at it. I mean, there are several ways to play Amazon. You can play a QQQ, for example, which is only $300. And if you do the same zebra on QQQ, you will only spend $40 to get in instead of $377, and you can play that, and it probably has Amazon and many other things in it.
Yep.
So you can do that.
No,
And
To get the high
that's fine.
delta, of course, you need to pay more, right? To get the delta close to 1, you need to pay more.
yeah, no,
Yeah.
you if you, let's take a QQQ as an example here.
I mean, more means compared to the stock price. Right.
Yeah, you compared to
So, Bala,
this.
actually, if you can do me a favor, I mean, it will become a little bit more clear for comparison purpose. So, essentially, when we are doing buying 2 puts and selling 1 put, so in other words, like one is negating other, so essentially you are plus 1 long put. If you can compare that the $400 zebra that you had with a single put that also has a premium of $400. So just compare apples to apple. If I put 1 put for $400, how much delta would that be? So that will give me comparison if I do a single put, regular $400, or I use zebra $400. What is the difference in delta I will be getting it?
Okay, the $400 on Amazon we got was on Amazon call. Okay, we did the call on Amazon. So let us go and find out for $400 what you get.
You want to select all, I think, on top. Yeah.
$400 you get 85, 84. So for $400 you get about 84 to 85 delta versus 96 delta. So you got about 10 more delta.
Awesome.
That's a real benefit here.
That's really good. Yeah.
So Zebra gives you 10 more delta. You are right. This is a good one. I normally buy 85 delta, but I buy Leap 85 delta so that I have a full year to play. I don't buy 85 delta in 43 days out. 43 days out, 85 delta, in my view, is too high a premium I'm paying. I'm paying $35 premium here.
Yeah.
This $35 premium is what that 10 delta is. In Zebra, I don't pay that premium because it is zero extrinsic. And that's why I'm getting 10 more delta, I think, mathematically.
Yeah.
So Bala,
Is there another?
what's the
See,
typical
normally,
expiry window that
I picked a 45-day expiry. My suggestion to you is typically do a 30 to 60 days. That should be the range in which you should play Zebra. You can play Zebra, mathematically speaking, you can play 3 months, 6 months, 1 year also. You could play Zebra for 1 week. But my suggestion to you is, so the shorter you play, the lower the price it will be. Instead of $400, if you play 2 weeks, you'll probably spend $380. I don't know. We can go there and figure
Yep.
it out.
Yep,
But
yep.
you spend less money on shorter and more money on the longer. But the sweet spot is around 45, 30 to 40 days, 30 to 60 days, because that will give you, you are getting into the position based on a technical analysis to begin with. So you have to give your technicals to work
Right.
for a little bit of time.
Yeah, you can't do technical
So
for 1 year. Yeah.
yeah.
You can't do
So
technical for 1 year, you can't do technical for 1 week. You got to give it a little time.
Right.
right. So Bala, I mean, mathematically, if I do this for say a year out or maybe 2 years out, this almost becomes like a leap, right?
Yes, and Leap, I would rather buy a 85 Delta like we just talked about.
Yeah,
One call at 85 Delta is what I would
correct.
do for Leap. I wouldn't bother with the Zebra, back ratio, and all those things when I'm buying a Leap. I might as well go and buy a 85 Delta, a Leap 1 year out, 2 years out, and I can sell against it and to collect covered calls. And
Yeah, but if I'm getting higher delta for a lower price, wouldn't I just do a zebra for instead of doing a simple leap, I do a zebra that's a year out?
some people say, I have watched videos of Zebra where they are suggesting that. But to me, Zebra is a technical buy rather than a strategic buy. If you are going to go strategic, just buy one call or buy one put in the leap. If you're going to go strategic, if you think Tesla is going to crash down to $100, you buy a put long term. And if you think Amazon is going to go to 5,000, you buy 1 year leap 85 delta. 85 delta is a clean, simple one transaction. You can understand your position much. Zebra is a position that you have to watch, because what's happening is something that you have to watch. And if you buy 85 delta leap, and you can just don't even have to look at it, let it ride, and you will get the multiple. That's my assessment. In terms of simplicity, a leap 85 delta is much simpler than a full zebra. Zebra is a little bit more complex, as you saw just now. So you do zebra for a specific reason. That's what my recommendation is. Nobody's going to stop you from doing zebra for leap. Nobody's going to stop you.
So I have a technical explanation for that. The answer why leap versus the verticals or the zebra. So when you actually monitor the way the premiums move on these leaps, for example, you might have observed, if the stock is really fluctuating, the leap price only fluctuates a little, and sometimes even if the stock is falling, maybe like in the case of Amazon, like $5 also, the leap doesn't change because it's for the long term. And that's point number one. So you have a very less fluctuation on your price. The point number two is that the theta on this leap is so little that way most of the people, when they want to look for the longer terms, they look for either straight calls or straight puts. Basically, obviously, leaps is calls, obviously. So straight, not like a vertical or a zebra. Zebra or verticals are good when you are looking at the premiums fluctuating rapidly, and also theta all fluctuating rapidly. These are the places where you want to go for a vertical or a zebra. And within that also, as Bala mentioned, 1 week, 2 weeks zebra might not help you because you really need to be very sure. 2 months out is basically giving a round of error. If you thought something else is happening, maybe it might change the direction, kind of a thing. So you're just giving a little bit room, not too much room like a leap, but a little bit room, so that way the monthlies, 2 monthlies is what you're trying to like give yourself a time. So that's the reason why 60 month, even 30 days is fine, but I think 60 is making a lot more sense actually. That's the technical explanation.
Very good.
Thank you.
Thank
Thank
you.
you. Thank you for that. That was awesome.
Yeah, very good. Yeah, very good. Thank you.
Yeah, and one other point, what I do, which is working out really great in this, the multiple strategies, is if a stock is trying to go down, I basically sell a call. I'll repeat it. When it is going down, I'll sell a call. When it is going up, I sell a put. So the other way around, where typically I used to be also doing the old school style where, or another style which is called, if the stock is going down, I buy put. When a stock is going up, I buy call, kind of a thing. More than that, practically the way the theta works and the decay happens, and also the premium fluctuates, which basically directly related to the implied volatility. Do the opposite around. That means that if the stock is going up, don't buy call, but the sell the put. So other way around. So that way you are able to see. You can like watch, try it on a paper money kind of a thing. See the return of the value that you're getting, uh, by from the start of the day to the end of the day, not just like, oh, I want to like monitor it for like a half an hour, 1 hour. It doesn't make sense, kind of a thing. No, the big difference starts hitting when you do the quite opposite. The big difference starts hitting after 2 p.m., where it's trying to like the theta starts to kick in, and all these market makers try to like already kind of think to evaluate it to the next day, when you will see the big difference starting. So try that. That is another great the what is it called, option you have.
But the only problem with that, Venkat, is that you have to have more equity for that, right? So you have to be
No,
more careful.
no, you are
When you
doing
sell a put,
okay.
you
Maybe
have
maybe
to.
I did not. Maybe I did not. Sorry, my bad. Actually, I should have mentioned. When a stock is going up, I sell puts, debits, spread, put spread. So
Oh,
you
okay,
don't need
okay,
a put spread basically. So
okay,
that
okay.
too, the put spread, how I do is not just a small spread. If I'm strong on the direction, the spread, I will try to like take it. Let's say
And the spread
Tesla, I
is
try to
different. Yeah.
take it up to 40 spread difference. If I'm not so sure, but still want to play the play of going down. So sorry, if going up the other way around, then I'll try to like go for a difference of maybe 15 or 8 or 15. But if I'm very strong, I go all the way up to like even 40, as an example in Tesla. The difference in the spreads basically. So you're trying to maximize. You don't need this kind of like cheating the naked puts and naked calls, but you're still able to do that.
No, it's a good strategy. So, Bala, coming back to Zebra,
Yes.
is there an easy way to set up a closing order?
Yes. Very easy. Once you set up the order, I'm not here. I don't have a position here right now. It's not. You just set to your profit. Let us say, let's say you have a position, and then you want to get out if the profit hits 40%.
Yeah.
Then you just put a good to cancel order if it's 43 days. So you're typically taking 30 to 60 days. So you put a good to cancel order, put a 40% profit, 50% profit, whatever is your criteria, put a close position order in there. That's it.
So just create closing order and
create closing order. You enter into the
it will
order
create
once your position, and you just put a closing order.
I think
Somebody's
if you
asking.
select, I think if you select all the legs and you can just close all of them together, it's gonna give you that. At least I don't use Thinkorswim. I use the Schwab's Street Smart Edge tool, which is very similar. But then if you have like multi-leg contracts, then all positions, then all you do is you select all the
right click.
legs and you say close, and it's gonna come up with a custom closing screen which will have all the legs in it, and you can just set the price like Bala was saying. If you're happy with taking the
Do the same
50%
thing in
profit,
Thinkorswim.
I think
yeah,
it's create opposite order, I think, right? Is that what it is
Yeah.
when you do that thing?
yeah, that's what it is. Yeah, it'll do
So
it.
you create a closing order. You
Closing.
make sure the quantities are right. You put a closing order, make it into a custom closing order, and you put a net price. So you got into it at 402, and you want a profit of 50%. So you put a closing order of $600 for that position. You just
So do you see, because you have two legs, right? One
you can do a combined closing order. You can put a closing order
combined. Okay.
net. You can do that in Thinkorswim. That's what I do. I
Okay,
put a
that's
50%
what I was
profit.
asking. Okay, you can do a combined one because it has to match, right? Because the total profit
It has to match. It will do
you
it.
cannot put a separate closing order. It has to be a combined order.
Yes, it has to be a combined order. It can be done very easily.
Okay, I'll check
Thinkorswim
it out.
does the same thing that he was talking about on the Street Smart Edge. Thinkorswim also you can do the same thing.
Okay.
Yeah, it's yeah, you can absolutely do the same thing. It's just a different
So,
UI, but
so Dinakar, you were talking about opposite order, right? What is the difference between that and
I think
closing
that's
order?
what, at least what many of the videos that I've seen, if you want to get out after a certain profit, I think it says highlight that the order that you already have, and then you do, if you highlight that, Bala, and do create opposite order. I think it's, we highlight one of the rows and do right mouse
If you
click.
sell on the same day, then the order is still there. So intraday, if you try to reverse your position, it gives you the order. You can right click on it and you can see create opposite order.
Yeah,
But
create
after
opposite
that,
order.
yeah, but after that day, the order is no more there. It's only the positions. So
Oh,
that
I
you
see.
have
Yeah,
to
yeah.
select
So
individual position.
good point, because all the videos that I've seen, you need to have an exit strategy right when you create the option, the contract anyway. So that's when you do it the same day as you do that. So
When you say
Right,
opposite
exactly.
order, you can put GTC or
yes, you can. Yes.
Right. So Bala, how do you monitor this strategy? So after next day, I don't know if Thinkorswim provides or not. Is there an easier way to check your profit for this composite or 2 lakh position?
Yeah. Thinkorswim will give you, I mean, if you go into the trade window, your position, say here I have some, let me go to SPY. In the SPY, I have some position. I think I have some position here. See, because I'm a little bit constrained because okay, here, you see this, last time, long time ago, we did this thing. And so what is the profit PL from open, profit for the day? All these things are available for your combined position. When you have multiple options here, net of all that will show up here in the profit and loss open, profit and loss per day. Net of all these things will show up here. So you can monitor that. And
So
there's a
Thinkorswim
monitor
knows.
window also where you can see.
So Thinkorswim knows that this is a zebra position. For example, I have one zebra and then I have another call position for like 3 months different strike.
No. It doesn't
No,
do that. It will give you a total of the position, all of it. And then if you are going to have a lot of position here, if you just select, like for example, if I just select that one, the selected total it gives you here. So if I select 3 or 4 here, it will give you a selected total profit and loss from open PL per the day. It gives you for the selected items.
Oh, okay. So that will serve the purpose. I just select those two positions and that will give me the net for those two
That will give
positions.
you the net. You can watch it like that. Yes.
Oh, okay, perfect.
So, but the only thing is that the if you have too many positions, these three are related to that zebra. You cannot like easily identify basically unless you know them
yeah,
by heart.
you can name
Right.
them. You can name them as
You can
if
name
you go
them
to
and
a different
wow.
group.
Yeah.
Group them. Yeah. Mhm.
Yeah, Fidelity is pretty bad in that because I do a lot of like calendar spreads. So what it does, I have a 2 calendar spread. It just combines them into butterfly. It does all sorts of things, and I completely lose track. Like what was my original intention and what the Fidelity is showing today.
Oh,
They're totally
okay.
different.
Fidelity is the worst of all things. Yeah.
Well, I think a swim gives me plenty of options to find this out. And what I normally do is once a week or so, when I look into all my positions, I try to export that into an Excel. And then I have my own way of analyzing my positions in my Excel. So I that's what I use. I mean, you can export all these transactions into an Excel window and then deal with it there if you want to know what is making what for you. You can do that too.
yeah,
That's what I do. I don't depend on these guys too much when I
Yeah.
want to see whatever I want to see. And
But I think
before closing out, let me just talk to you a little bit about um, the position that we were here in Amazon, analyze trade. We were
yes, that's
talking.
what I was going, Bala. That showed exactly. It's quite different than a standard vertical spread where the top and the bottom are cap kind of thing, right?
See, there is no cap here.
Right.
So if there is a breakout scenario, your maximum profit is not capped. It keeps on going, and your maximum loss is capped at this whatever money you have spent on the stock. In this case, it happens to be $400,000, but that's your maximum. your profit is not. So you can do an analyze on your position, multiple of your positions anytime, like you normally do. I don't think I have anything else. Let me just make sure I didn't miss anything. That's it.
Just one
Bala,
last question. Can you set up
can
an
you do me a
alert on
favor?
the Zebra? Like
What is
give
that?
me when I get, can you set up an alert that give me alert when 50% target is reached, 50% profit is reached for the Zebra position, something like that?
I don't know whether it allows you for the position, but you can calculate because Zebra is one delta, full delta. So, for example, if you want $200 profit, you just need $200 more from the current price of the stock, and you can set an alert like that, and that will give you that alert.
Right, right. I think you're right. That will give the same thing. So, yeah.
That's what I do actually. I set up an alert based on where it has moved.
So on the actual stock itself, you set up an alert.
Yeah. Yeah, alert, I don't know whether alert can be done for a strategy. Alert can be done for a position, I think.
But
Of
I
course.
think if you do the create opposite trade for this, and then you obviously change your price based on calculating from how much you're expecting, that'll do it essentially. So so yeah.
You can set up alerts many different ways. Yeah.
Yeah. So Bala, can you do me a favor in the deck? Can
Mhm.
you just write down the steps in Thinkorswim, like select the
Yeah, I
thing,
can add a slide. I can add a slide.
add a slide on step by step and how to set it up, like divide by 2 and go and look for that.
Yes, yes. I will do that.
Okay,
Yeah,
thank
that calculation seems little confusing unless we by heart it a couple of times or practice
you.
couple of times.
That is why I will post the deck also in the website, though that way it will be there.
I will do that addition to the deck and then I'll send it to you.
Yeah, yeah.
You can post that.
No,
It
this
may
is
be
great.
problematic in the tools that do not show extrinsic value explicitly. So there you have to calculate manually, right? Have to.
In Thinkorswim, you don't have the problem because
Add
you can
columns.
add extrinsic value as one of the columns in the layout. If you go to the layout, you can add extrinsic, intrinsic. You can add all kinds of things. You can customize. You can add a lot of columns here. That's what I do. I don't know other. I would expect everybody else to be able to do that as well.
Yes, yes.
But you do need to know the extrinsic value
Correct. Because
displayed
that is
for
what you are
you
dividing
to
by
access.
2.
Yeah, either you have to do mental math or you have to do paper and pencil math, but you have to do that. That's all I have, guys. I don't really have anything else unless you have any more questions.
No, this is great, Bala. No, timely also.
Yeah, I think now you better get into your technicals, your stochastic momentum indicator, MACD, Bollinger Band, and candlestick. Get into all your technicals to find out when the bottom is, and then go for it.
Yeah. Can you look at the technicals for RK quickly?
Yeah. This one, right? Innovation.
Yeah, RK.
So it's rock bottom right now.
Yeah,
Gonna shoot up, Nari. Yeah.
I hope so. But the technical is still going down, right?
Yeah.
Yeah,
That's the thing. We don't know
It is
which is
not.
the
We have
bottom.
not
Yeah.
seen any. We have not seen any candlestick that you know doji has not appeared yet. We need a doji for candlestick to help us get to the bottom. It is at the bottom of the band, but it keeps going down.
Yeah, it still keeps going down.
So
Yeah.
where is
yeah. These
Zebra?
days technicals became very tough actually. In the past, it was like dojis or the Bollinger Bands or things like that. But nowadays, being a technical guy, what I'm seeing is that you cannot, just like anybody else, you cannot time the bottom or look identify the bottom. The only way is once it is bouncing back upwards, lose that first couple of bars, and then that's the only way you're able to find it out, because
I
market makers
agree with
became
you
so
100%.
tricky.
Even on, like, a couple of days back, it started bouncing to 87, 88, and then it came down to 80 today.
Yeah, it's a false positives they're giving. Is becoming very, very challenging these days for any technical analysis.
And yeah, for the technical analysis, because it is a combination of 30 different stocks, right? So I don't know, does the technical analysis work on like these ETFs as well
Yeah,
as
still
stocks?
it still works. Yep, absolutely.
I think technical analysis is basically like horoscope reading, you know.
Yeah. That's a good one, Bala.
See, even all these ETFs and anything, if you see if the indexes are turning around, all the ETFs will turn around, all the stocks will turn around, unless that particular stock has a bad luck or anything, they all has to turn around. So in that fashion, if you see what is technical analysis, it tries to look for the trend, and obviously they all will say green means everything will say green. They say red means everything will say red at a high level, 90-80% of the time. So that's the reason why the ARC or ETFs or anything, the technical analysis still will work.
Yeah.
So we kind of saying for this one, we haven't recognized a support level yet for this.
No, this one, I'm also looking at it. I mean, no, not really. Still going down. That's what I thought the previous couple of turns. But
Yeah.
when it touched that Bollinger Band, that 90, 91, that area, I thought this is it kind of a thing. But no, it's not stopping.
No, I sold a put at 80 first, and then it went to 87, and I was good, and then it dropped to 79.85 today.
Yeah.
Yeah, ARC is a tough one. But, you know, she's been successful in the past, but
So Bala, I
yes,
have this is Kuldeep. I did your leap on a spy on the
yeah,
on demand for 1 year on
yes.
2017 and 18, if I'm not mistaken. So I bought 2 year leap, and for 1 year I keep selling 35 to 20 delta call
Okay.
against that. And I find it at the end, I was end up paying 11,000 or something towards that, because they were always going in the money. So a few of our friends were sitting together and thinking through it, how to mitigate that problem, because whenever there's a breakout, you will go in the money and you have to buy back or break even and
You have
go
to keep
into a little
rolling.
lower price.
Yeah, you have to roll over.
Right. So I did that, rolling over at the same price. And so what we were thinking is, and we're gonna do it in the on demand again, to sell at 35 delta. So first buy the leap at 85 delta or 80 delta, then sell 35 delta cover call weekly. And when you sell, whatever the premium you get, use some premium to buy additional call, little out there. So even if it breaks out, you have other call that is generating money, and
It's a
you're
good
not,
option.
you are not, you give up some gain, but whenever it breaks out, you're not have to buy back at very expensive. You have something that is working out. So I'm gonna see how it works out, and see if I can put some feedback.
So, but your overall position, because you have the leaps, right? It will
Hmm.
still go up, right? So overall position is still good when
Yeah.
this breaks out.
Yeah, so I'll tell you, for that time particularly, I think SPY moved 20% up.
Yeah.
if my call, if I would have kept the leap call that was for 2 year out, in 1 year, if I would have sold, I would have made
100%
45%,
only.
45%, you know.
45.
Instead, I end up paying like 11,000 back. So out of that, you know,
Yeah, that is
because
the yeah that is
yeah,
the typical problem. See, the leap strategy is also called poor man's covered call, right? So you have all the problems of covered call. Covered
yeah,
call, that is the problem. If the market keeps going up, you have to keep rolling, or you have to, you know, lose the stock or something,
yes, yes,
See,
right?
I
So the
think
same
one of the
problem is
ideas
there.
is one of the ideas is SPY and some of the ETFs will probably not break out like this, but
Yeah,
a particular stock is going to break out. So maybe you could have the strategy that you're talking about, spend some of the money from the 35 delta to buy an insurance
yeah,
for a breakout, and then do that for a stock rather than for an index. Maybe that's more
yeah.
workable because the index doesn't break out as much as
So like, yeah, 2021 was an exception for SPY, right? So it is.
yes.
Yeah,
SPY this year, for example, I don't expect it to go more than 8 to 10%
yeah,
at the maximum.
yeah. So
How
this year
about
that they're
Microsoft
talking about
Leap?
it will be choppy, right?
This year will be choppy, but I think this year the 85-35 will work better.
yeah, yeah. This market, it will definitely work. Even covered calls will work better here.
Yeah.
Yeah. How about Microsoft Leap calls? Is it a good strategy to go for that stock?
I do that. I'm on Microsoft. I'm still on Microsoft. I'm losing now because it has gone down today, but I'm on Microsoft. Yes, but it has been good for me last year. Yeah, the same
Sell
85.
those covered calls
I
35,
sell 85,
but
35, 85, 35 and roll, and I have been doing that on Microsoft. It has done very well last year. This year, right now, it's down, but hopefully it will come back up.
but you
Bala, one
don't do
question.
you don't do the
Sorry, go ahead.
covered calls on the day the market is down.
I don't try to time the market. I go by formulas. If I sell a 35 delta call, if it goes against me, I will roll it to break even if it is 2-3 months, and then when I come close to my original leap, if I bought it last year, then I will try to make it into a vertical and then get into a new position. That's what I do. I try to play it as pure to the strategy as possible. Whatever results it provides, it provides. I don't try to fine tune it, but it is possible to fine tune it. I like you were suggesting buying a little insurance
Yeah,
is not such a bad idea. The Nanban strategy suggests insurance not on
correct,
only on the breakout side, breakdown side also they suggest
yeah,
you to
yeah,
buy a put and buy a call
correct.
using some
So
of the money.
opportunistic call.
Yeah, you could do the same thing on this poor man's collect call as well, covered call as well. You can do exactly the same thing, except that instead of buying SPY, you just buy a leap and then you
Correct.
do everything else the same way. You could do that. The only problem with this insurance is it becomes a little complicated. If I spend maybe 15-20 minutes, maybe 1 hour at the maximum on my trading desk per day, if you do a lot of trades, then you have to spend a little bit more time. I spend more time on analyzing and fundamentals and other
Yeah.
things. So
So
you have to
another problem with insurance is you are losing the time value, right? So that time value you're paying for it.
yeah, you are definitely paying for it. You can try to do some strategies by which you buy the insurance
Yeah,
for 3 months rather than
correct.
every week, just to make it easy on yourself.
Yeah,
That mathematically one will be better than the other. It's just to make it easy on yourself.
yeah.
So Bala,
Good.
I know
Any other
when
questions?
Bala, one question on Leap. So I've observed trying to do a dry run based on some of the videos that I watched during this training sessions, that
Yes.
when you look at the 0.85 delta, the premiums are pretty high that you're paying upfront, right?
Yes.
So, and if I also do calculation of the like covered calls, I would do, assuming I'm able to do it weekly, and say for example, I'm going to give you an example of PayPal. So I was looking at a premium of 85 delta. It was about $6,000 or $7,000. I don't remember right now. I was looking at it like a couple of weeks back.
Yeah.
And when I calculated the like a covered call weekly, I was like, it won't. I have to assume that the price will go up, and which will recover my leap call. But if I have to assume like a covered call weekly on it, it was not like calculating against a 20 delta or 35 delta that I'll recover the cost for the leap. Does it make sense for the question what I'm asking maybe?
No, because to me, see, take PayPal. If you are now buying a leap call 20th January 23 at 85 delta, you are paying an extrinsic value of about $8.17. So all you have to, and the strike price is 125, and you're paying $64 for that, and all you have to do is collect $8.17 in various covered calls to pay for this over a period of, and if you go for a weekly, let's say 1 week from now at 35 delta, it gives you $2. So the $8 will get covered up in about 4 profitable weeks.
I see. Okay.
Rest of the time you break even, the covered call is not going to cost you anything. And then if the stock goes up, the 85 delta,
That's where you make the money.
that's
I
where
see.
you make.
No.
See, one thing in the 85-35 strategy, that about 70% of the profit, 60 to 70% of the profit is made on the leap. Only 30% of the profit is
Correct.
made on the covered call.
Yeah, even though it is an income strategy, most of the money comes from appreciation rather than regular income.
That's
So,
correct.
so when Coach Rene had explained the same thing on his Amazon leap, he was suggesting go like 1 or 2 below the 0.5,
Yeah.
right?
That
Yeah,
is
his
not the
strategy is
85-35
different.
strategy. That's a different strategy altogether.
Okay.
Yeah, the 85-35 strategy is a specific strategy. Just like leap, zebra, just like vertical, every strategy has to have its own logic points. You cannot mix one with the other.
And when so Bala, the 85 thing, like if the stock has appreciated or stable, then when do you actually close the leaps option?
Well, believe it or not, I don't close it until the leap expires. I don't close at all. I just stay there, and I don't close at all. But what I do is, if the stock has moved up a lot, what will happen is, over a period of time, this 85 delta would become more like a 95 delta, right? 6 months from now, the stock has moved $30, let us say, and the 85 delta would have become 95 delta. Then I will roll it down to 85 delta.
Right.
I
No,
will
but
collect the money
so
from the.
at the end on the expiration date, and if you have not exercised, you'll automatically buy the stock.
No, I will close out the position and take the.
Right. You
I will
have to
take the money.
exercise, right? Otherwise, it'll expire worthless.
So will you do like
No,
sell
it won't
to
expire
close at that
worthless.
time? Will you do sell to close at that time?
Yeah, I'll sell to close.
Okay.
Sell to close, yeah.
Okay.
I will sell to close, but usually what I do is I will go into a vertical. Right now, there are many stocks which are expiring now. Unfortunately, the first month of January is not good for me. But many of my lead positions are expiring. They have become verticals now. By now, they are all verticals. I'm sitting on verticals, but I have rolled also. So I've collected most of the money out of the position. So I roll both the long end and the short end. so that I'm still sitting on 85 delta almost all the time.
Okay.
So Bala, when you say buying leaps and not touching them, you don't touch them, for example, like 2 to 3 years, or
I
you
roll it back to 85 delta. See, when
so
I get into
basically,
a position, when I get into a position at 85 delta, if that position moves to 95 delta, I will roll it back down to 85 delta and take the money out of the position.
Cash out some of it.
Cash out, yeah, cash out, kind of like, yeah, okay.
I'll keep cashing out every time the delta moves. When the stock moves up, I will cash out.
But you don't adjust your leaps based on the market direction. As an example, you showed the Amazon stock every 3 months it's taking a different turn. That way, whatever you made, you're losing kind of thing, right?
No. I was showing that only for the zebra strategy.
No, in general, if that happens to your, let's say your Amazon, you bought it for like 2 years ago, you left it like that, and you're trying to like roll it from 95 to 85, 95 to 85 whenever you get the opportunity. But if that is going as a roller coaster for every 3 months, Amazon stock, you're making, let's say, $80,000, then it becomes 50,000, then it becomes another 60,000, then it becomes like 40,000. So you're pretty much losing whenever that big curves are happening. The leaps are losing a lot of money. You don't care about the market direction, the big market directions every 2-3 months.
No, I don't. Because again, it's a style. There are some people who would push the leap out by 6 months. After 6 months, they buy the leap for 1 year. After 6 months, push it out by 6 months. Like that, there's one way to do that. I don't do anything like that. I just take a position and let the position play itself out. If I want to take another position, I will take another position with another leap on the same Amazon. So the ups and downs, so the dollar cost averaging you do based on, hey, when the market is down, you buy one more contract. When the market is up, you try to sell or try to roll your 90 delta down to 80, 85 delta. So,
but you don't close them. If a big directional changes happen, you don't close them.
Only if I lose faith in the stock. I'm not losing faith on. I play Apple, Google, Berkshire Hathaway B, Amazon, Microsoft. I'm not losing faith in any of these stocks.
Got it.
Yep. Okay. No, this is a great session. I think we are running out of time, guys. Maybe one last question.
Yeah.
Okay. I'll just ask it very quickly. Bala, by rolling it down to 95 to 85, you're missing out on the tax advantage. Now it's a short-term gain in place of long-term gain. Do you care
Not in
for
IRA
that or
account,
no?
right?
Yes. Short answer to your question is yes. But I only am allowed to play by my wife a percentage of my portfolio on this. My wife manages 80-90% of the portfolio, and she does her stuff on the stock, and she doesn't do any options. So this is just one position for me. I tell everybody this is all short-term gains and that's it. And the long-term
The advantage with the leap is you don't have to pay the taxes, you know.
yeah, that's true.
But by rolling it down, you might have to pay the short-term gains.
Okay. That's
so
what you're saying.
That's true.
Just be careful with that.
Yeah, no, I'm not careful with that. I'm consuming everything in short term. But you are right. If I leave it alone, which I do sometimes, I have to say, sometimes I leave it alone. I don't touch it. Try to get that long-term capital gains, especially if something has done really well. Like sometimes the SPY, when I buy a long-term leap on SPY, I just don't do anything and just leave it alone. I do that.
Okay.
But not on my favorite stocks like Amazon, Microsoft, Apple. I don't do that.
Yep.
Lately, I was also in the same boat, Bala, in the past. Favorite, I had those attachments kind of a thing, but what I've been doing since the last couple of years, at least, is that there is nothing called a favorite anymore.
Yeah, that's true.
Google, Microsoft, whatever. When a strong market directional change happens, obviously I cannot time it. Happens, I don't care. Just close it off and then re-enter the leaps a little later, because
Right.
I have burnt a significant amount of money where you get it into your hand, then you see them losing because you are like attached to that stock because they are like big companies. So it's not really help. At least what I learned as a lesson was like it was not really helping. Directional changes, just close it out and reopen it when you need it. Just like as you're doing 95 to 85, it's another way of cashing it out. But my way of doing it out is like 100% hardcore, like 100 to 0. Take it, close it out, kind of a thing, and then re-enter when you need it.
I
Yeah,
agree with
makes
you.
sense.
I agree with
So,
you. You
yeah,
gotta have more discipline.
I think we can close because it's already more than 90 minutes. Thanks a lot, Bala. It was a very
Thank you.
illuminating presentation.
Thank you
Thank you,
very
Bala.
much, guys.
Thank you,
Bala.
Bala. Thank you very much.
Very useful for everyone.
Bye bye.
Thank you all. Thank you guys.
Thank
Thank
you.
you.
Bye.